Tonight, everything changes. At exactly 3 a.m. Eastern, while most of the world is asleep, London will quietly set a price that could expose a truth buried for decades. The East is paying far more. The West is pretending nothing's wrong. Millions of ounces are leaving vaults, yet the price says, calm? This has only happened a handful of times in modern history. And every single time, someone blinked and someone paid the price. The question isn't if something breaks. The question is, who breaks first? Welcome back to Market Metal. If you are someone who lived long enough to know that markets don't lie forever, but people sometimes do, then this channel is for you. Take a moment, subscribe, not because of hype, but because wisdom comes from watching carefully over time. And before we go any further, tell me in the comments, where are you watching from today? The pricing authority at risk. Why London? Still matters. For more than a century, global silver pricing has revolved around one place, London. Long before electronic trading screens and instant data feeds, London became the center where metal was stored, financed, insured, and priced. Even today, when silver is traded around the world every second, the price set through London still acts as the reference point for contracts worth tens of billions of dollars each day. At the center of this system sits the London Bullion Market Association. The LBMA does not mine silver, refine it, or consume it. Its role is simpler but far more powerful. It provides the framework through which banks, refiners, vault operators, and large institutions agree on what silver is worth at any given moment. That agreed price is then used to settle futures contracts, price exchange traded funds, set industrial supply agreements, and value national reserves. This is why the London Open matters. Each trading day begins quietly. Before the official price fix, large banks and dealers position themselves in the early London session. This period, often ignored by retail investors, is where risk is adjusted and pressure builds. When conditions are normal, the London Open simply continues trends already in motion. But when conditions are strained, it becomes a stress test. It forces the system to reconcile paper prices with physical reality. Historically, London earned its authority because it could always deliver. Paper contracts were trusted because they were backed, directly or indirectly, by metal sitting in London vaults. This balance created confidence. Traders could buy or sell without worrying whether the silver existed, because the system had proven over decades that it worked. But pricing authority is not permanent. It depends on credibility. In financial history, benchmarks lose power not through sudden collapse, but through quiet erosion. Small inconsistencies appear. Premiums widen in other markets. Inventories fall faster than expected. Delivery times stretch. None of these events alone breaks a system. Together, they raise a question that serious market participants cannot ignore. Does the benchmark still reflect reality? London's role in silver pricing is built on two assumptions. First, that paper liquidity can stand in for physical supply. Second, that any physical demand can be met if needed. As long as these assumptions hold, London remains the unquestioned center of price discovery. The challenge arises when demand for physical metal increases while available supply shrinks. Silver is not only an investment metal, it is an industrial input used in electronics, solar panels, medical equipment, and defense applications. This means that physical demand does not disappear when prices become volatile. Factories cannot replace silver with a chart or a contract. They need metal. When physical demand grows faster than new supply, inventories become the buffer. Vaults absorb the pressure until they cannot. Once withdrawals accelerate, the market shifts focus away from price movements and toward availability. At that point, the benchmark price is judged not by how smoothly it trades, but by whether it still makes sense compared to what buyers are actually paying. This is where London faces its greatest test. The LBMA market is largely an over-the-counter system. Trades are bilateral, opaque, and highly leveraged. Large volumes change hands daily, but most of it never results in delivery. This structure works efficiently when confidence is high. Participants assume that contracts can be rolled, offset, or settled in cash if needed. Physical settlement is the exception, not the rule. However, when physical settlement becomes more common, the system's priorities change. Leverage that once improved efficiency begins to amplify risk. A market designed for liquidity must suddenly deal with scarcity. In past decades, London has navigated similar moments. Each time, the system adapted. Prices moved higher, demand cooled, or new supply entered the market. Authority was preserved because the market ultimately cleared. What makes the current environment different is the global nature of demand and the reduced flexibility of supply. New silver mines take years to develop. Recycling responds slowly to price changes. At the same time, industrial use continues regardless of market stress. This leaves inventories as the only short-term adjustment mechanism. As inventories fall, pricing authority becomes fragile. London does not merely publish a price. It provides a signal. That signal tells producers whether to expand, consumers whether to hedge, and investors whether to allocate capital. If the signal becomes distorted, decisions across the global economy are affected. This is why institutions care deeply about whether the benchmark remains reliable. The early warning signs are subtle. When other regions consistently pay more than the benchmark, it suggests that the reference price may be too low. When metal leaves vaults faster than expected, it suggests that holders value possession over promises. When delivery terms tighten, it suggests that confidence is being rationed. None of this means that London is about to lose its role overnight. Pricing authority fades gradually. First, it is questioned privately. Then, it is hedged around. Only later is it challenged openly. For professional investors and business leaders, the key issue is timing. Markets often appear stable right up until the moment they are forced to adjust. Those who rely solely on headlines miss the shift. Those who watch structure see it forming. The London Open is important because it compresses these pressures into a narrow window. Banks must decide whether to defend existing positions or adjust to new conditions. Dealers must decide whether to quote aggressively or step back. The system must decide whether to maintain continuity or acknowledge strain. This decision is rarely announced. It is reflected in price behavior, volume, and spreads. A smooth open suggests confidence remains intact. A disorderly one suggests that assumptions are being challenged. For decades, London's authority rested on its ability to reconcile paper and physical markets. When that reconciliation becomes difficult, authority becomes conditional. Conditional authority is not failure, but it is vulnerability. This is why tonight matters. Not because it guarantees a dramatic price move, but because it reveals whether the benchmark still commands trust under pressure. If London can price silver in a way that aligns with physical realities, its role is reinforced. If not, the market begins to look elsewhere for signals. History shows that when benchmarks weaken, capital adapts quickly. Institutions reduce exposure, rewrite contracts, and seek alternative references. These shifts often happen quietly, long before public narratives change. Part 1 establishes the foundation. London still matters because it remains the center of trust, but trust is not infinite. It must be earned daily through delivery, transparency, and relevance. The question moving forward is not whether silver prices will rise or fall tomorrow. The deeper question is whether the system that sets those prices can continue to do so without contradiction. That question brings the analysis to the next stage. What happens when different parts of the world begin to price silver as if London S signal no longer tells the full story? East versus West. When arbitrage stops behaving normally. For most of modern financial history, price differences between regions were not a threat. They were a feature. When silver traded slightly higher in one market than another, traders stepped in. They bought where it was cheap, sold where it was expensive, and closed the gap. This process, called arbitrage, kept the global system balanced. It was quiet, mechanical, and reliable, until it wasn't. What makes the current moment different is not that silver prices differ between regions. It is that the difference has become persistent, wide, and resistant to correction. That is the point where arbitrage stops being a stabilizing force and starts becoming a warning signal. In the Western system, silver pricing is dominated by paper instruments. Futures contracts, swaps, and unallocated accounts represent claims on silver rather than ownership of it. These tools are efficient. They allow large volumes to trade with little friction. Most participants never expect delivery. They trade exposure, not metal. In the East, the mindset is different. Physical settlement matters more. Ownership is valued over promises. And when buyers pay a premium, they do so for metal that can be delivered, stored, and used. This difference in approach has always existed, but it rarely affected pricing at a global scale. London's benchmark usually kept everything aligned. Now, that alignment is under strain. In recent weeks, the price of silver in Asian physical markets has moved far above the London reference price. This is not a brief spike caused by local demand. It is a sustained premium that refuses to close. Each day it remains, the signal grows stronger. For arbitrage to work, 3 conditions must hold. First, metal must be available in the lower-priced market. Second, it must be movable at reasonable cost and time. Third, sellers must be willing to part with it. When any of these conditions fail, price gaps stop closing. The current environment suggests all 3 are under pressure. The Western paper market shows abundant liquidity. Contracts trade freely. Prices appear calm. But physical metal tells a different story. When buyers in the East are willing to pay significantly more, it suggests scarcity where it matters most. Not scarcity on a screen, but scarcity in vaults. This is where suspense enters the system. Markets are built on assumptions. One of the strongest assumptions in global commodities is that price differences cannot last. When they do, professionals begin asking uncomfortable questions. Is the cheaper price real, or is it an artifact of leverage? Is the higher price temporary, or is it revealing something structural? The longer the gap persists, the harder it becomes to dismiss. Historically, sustained regional premiums in silver have preceded major price adjustments, not because traders suddenly became emotional, but because the math forced their hand. When demand concentrates in markets that insist on physical delivery, paper markets must respond. Either they raise prices to retain metal or they lose relevance. The East is not merely bidding higher, it is signaling priorities. Industrial users in Asia rely on silver for manufacturing. Solar production, electronics, and advanced technology do not pause for market volatility. These buyers are not speculating. They are securing inputs. When they pay a premium, they are telling the market that availability matters more than price efficiency. This behavior changes the balance of power. In a paper-driven system, sellers control the flow. Contracts can be issued without immediate consequence. In a physical-driven system, buyers set terms. They pay more, but they demand certainty. When enough demand shifts toward certainty, the paper system must adapt or retreat. The tension between these systems creates a silent standoff. On one side, Western markets continue to quote prices that assume liquidity and flexibility. On the other, Eastern markets operate as if metal is finite, it must be secured now. Both prices exist at the same time. Both claim legitimacy. Only one can ultimately dominate. This is where arbitrage usually steps in as the referee, but arbitrage cannot move metal that is not for sale. It cannot force holders to release supply. It cannot compress a spread when physical withdrawal accelerates. As this imbalance grows, the risk shifts from traders to institutions. Banks and large intermediaries rely on arbitrage to manage exposure. When spreads widen beyond normal ranges, hedges weaken, models fail. Risk that once looked diversified begins to concentrate. At that point, decisions become defensive. The market does not announce this transition, it whispers it. Volume changes first, then bid-ask spreads, then delivery terms. Only later does price follow. By the time headlines react, capital is already repositioned. The suspense lies in timing. If the Western benchmark adjusts upward, it validates the physical signal. Trust is restored, but at a higher price level. If it does not, the premium becomes a tax paid by those who need metal most. That tax grows until someone breaks. Historically, when arbitrage fails, one of two outcomes follows. Either physical supply is released to close the gap, or the benchmark price resets to reflect scarcity. In the current environment, new supply is slow, and holders appear unwilling to sell at existing prices. That narrows the path forward. This is not a story of East versus West in a political sense. It is a structural divide between two pricing philosophies. One prioritizes liquidity and leverage. The other prioritizes possession and certainty. When both systems are calm, they coexist. When stress rises, one must yield. The market is approaching that moment. The sustained premium is not noise, it is pressure. It tells institutions that the usual mechanisms are no longer working as expected. It tells manufacturers that waiting may be costly. It tells investors that price signals may be incomplete. For business leaders and entrepreneurs, this matters beyond trading. Pricing benchmarks influence contracts, costs, and long-term planning. When benchmarks lose alignment with reality, risk moves from speculation into operations. The question is no longer whether arbitrage will act. The question is whether it still can. As the spread holds, the system faces a choice: adjust pricing to reflect physical demand, or accept a fractured market where different regions trade at different realities. Neither option is neutral. This tension sets the stage for the next phase of the analysis. When price gaps persist, attention shifts from price itself to the infrastructure that supports it. Vaults, inventories, and delivery obligations move from the background to the center of the story. That is where the real pressure begins to show. Inventory stress and counterparty risk, when availability becomes the price. Markets often fail quietly before they fail visibly. Long before a price collapses or explodes, stress appears in places most people never look. It shows up in inventory reports, delivery schedules, and settlement terms. These are not headlines, they are accounting lines. But for professionals who understand markets, they are the earliest and most reliable warning signals. In the silver market, inventories are not a detail, they are the foundation. Silver trades globally in enormous volumes every day, yet only a small fraction of those trades ever result in physical delivery. The system works because it assumes delivery is possible, even if it is rarely demanded. As long as that assumption holds, confidence remains intact. When it weakens, the entire structure becomes fragile. The current environment is defined by one growing concern. Metal is leaving faster than it is being replaced. Vault inventories exist to absorb shocks. They smooth demand, support settlement, and provide reassurance that the system can handle stress. When inventories decline slowly, the market adjusts without panic. When they fall rapidly, questions begin to surface. The first question is simple: why are holders choosing possession over paper claims? Physical silver does not leave vaults without intent. Withdrawals are deliberate. They cost money. They take time. They require storage and security. When large amounts of metal are removed, it signals that the holders believe future access may be uncertain or more expensive. This behavior changes the market's psychology. In a healthy system, participants are comfortable with exposure. In a stressed system, they seek control. Exposure can be hedged, control cannot. And when the preference shifts toward control, the market stops behaving normally. Inventory stress forces a reevaluation of counterparty risk. Counterparty risk is the risk that the other side of a transaction cannot perform as promised. In paper markets, this risk is often underestimated. Contracts are assumed to be safe because they are settled daily, margined, and supported by large institutions. But these protections rely on liquidity and confidence. They do not create metal. As inventories fall, the gap between promises and resources becomes harder to ignore. Each paper claim is backed not by a specific bar, but by the system as a whole. This works when claims are few relative to available supply. It becomes dangerous when claims multiply while supply contracts. At that point, settlement depends not on ownership, but on cooperation. Cooperation holds until incentives change. When demand for delivery increases, participants face a choice. They can source metal at higher cost, negotiate delays, or settle in cash. None of these options are neutral. Each reveals strain. Each signals that the system is adapting under pressure. This is where suspense builds. Inventory stress does not cause immediate failure. It creates a countdown. Every withdrawal reduces the buffer. Every delivery request tests capacity. Every delay raises awareness. At some point, the margin for error disappears. Professionals understand this dynamic well. It is why inventory data is watched closely during periods of market tension. Price charts show movement. Inventories show commitment. The silver market's structure magnifies this effect. Because most trading is unallocated, many participants are exposed to the same pool of metal. When confidence is high, this pooling is efficient. When confidence falls, it becomes a liability. The system begins to resemble a crowded exit. No one panics at first. Participants assume others will stay put, but as withdrawals continue, the logic shifts. Those who move early secure certainty. Those who wait risk being last. This dynamic is not emotional, it is rational. Counterparty risk grows non-linearly. It increases slowly at first, then rapidly once thresholds are crossed. By the time it becomes obvious, it is already embedded in the system. This is why institutions react before public recognition. Banks, refiners, and large consumers monitor not just total inventory, but the rate of change. A stable decline is manageable. An accelerating one is not. Acceleration suggests that behavior has changed. It suggests that confidence is being replaced by urgency. Urgency is contagious. When one major participant chooses delivery, others reassess. When several do, the signal becomes clear. The market begins to price not abundance, but access. This shift affects more than investors. Industrial users rely on predictable supply. When inventories tighten, procurement strategies change. Contracts are renegotiated, stockpiles increase. Costs rise quietly before they rise visibly. Financial intermediaries face a different risk. They are positioned between buyers and sellers. Their role is to facilitate flow, not to warehouse metal. When delivery demand rises, intermediaries must source metal or manage expectations. Both options carry risk. Sourcing metal at higher prices compresses margins. Managing expectations risks reputational damage. Neither is attractive. As stress builds, defensive behavior emerges. Quotes widen, minimum quantities increase, settlement terms tighten. None of these actions are announced as crises. They are framed as market conditions, but together they mark a transition. The market is no longer operating on trust alone. At this stage, the benchmark price begins to lose informational value. It reflects transactions that assume flexibility, not transactions that demand certainty. This divergence is subtle, but it matters. Price is no longer the only signal. Availability becomes equally important. When availability becomes scarce, power shifts to those who hold inventory. They decide when and at what terms metal is released. The market moves from continuous flow to controlled distribution. This transition is uncomfortable for leveraged systems. Leverage amplifies efficiency in calm markets. In stressed markets, it amplifies risk. When inventories are thin, leverage reduces tolerance for error. Small disruptions have outsized effects. This is why inventory stress often precedes volatility. The market senses fragility before it sees it. Participants adjust behavior quietly. They reduce exposure, extend timelines, or seek alternatives. These actions reduce liquidity, which in turn increases stress. The cycle feeds itself. For observers who only watch price, this phase looks confusing. Prices may stall or move erratically. Headlines may suggest stability. Yet beneath the surface, the system is tightening. This is the suspense of inventory stress. Nothing dramatic has happened yet, but the conditions for drama are forming. History shows that markets rarely collapse without warning. They signal through structure before they signal through price. Those who understand this do not wait for confirmation from headlines. They watch the mechanics. In silver, the mechanics are telling a clear story. Metal is being withdrawn, delivery matters more. Counterparty risk is rising, the buffer is shrinking. None of this guarantees a specific outcome tomorrow, but it narrows the range of possible outcomes over time. The market is approaching a point where it must reconcile claims with resources. When that reconciliation happens, it will not be driven by opinion or forecasts. It will be driven by math, and math does not negotiate. This sets the stage for the final phase of the analysis. When inventories tighten and counterparty risk rises, the consequences extend beyond the market itself. They reach into capital allocation, industrial planning, and policy decisions. That is where the impact becomes unavoidable. Strategic consequences. When a market stops being a market, every financial system reaches a moment when it must choose between appearance and function. As long as prices move and contracts settle, a market can appear stable. But when availability tightens and trust weakens, stability becomes conditional. The system continues to operate, yet it no longer behaves as designed. That is the stage the silver market is approaching now. At this point, the question is no longer about daily price direction. It is about consequences. When a benchmark price loses alignment with physical reality, the impact spreads outward. It touches capital allocation, industrial planning, and policy decisions. These effects unfold quietly at first, but once they begin, they are difficult to reverse. For institutions, the first response is defensive. Large investors and corporations do not wait for confirmation in the news. They adjust exposure early. They shorten contract durations. They reduce reliance on benchmarks that appear strained. They seek optionality rather than efficiency. These shifts are subtle, but they signal a loss of confidence in the system's ability to absorb shocks. Capital begins to behave differently. Instead of chasing yield, it prioritizes certainty. Instead of maximizing leverage, it minimizes dependency. This does not happen because participants expect immediate collapse. It happens because they recognize that the margin for error has narrowed. When a market enters this phase, volatility becomes a symptom, not the cause. For industrial users, the implications are more direct. Silver is a critical input in sectors that cannot pause production without cost. When supply reliability comes into question, procurement strategies change. Companies build inventories. They accept higher prices in exchange for guaranteed delivery. They shift from just-in-time to just-in-case. These decisions increase demand precisely when supply is least flexible. This creates a feedback loop. Higher precautionary demand tightens availability further. Tighter availability increases perceived risk. Risk drives more precaution. The system becomes self-reinforcing. At this stage, price becomes secondary. What matters is access. A market designed around continuous liquidity struggles to adapt to this shift. Its tools are built for trading, not rationing. When demand exceeds willingness to sell, prices alone cannot resolve the imbalance quickly. Adjustments occur through non-price mechanisms, delays, minimums, exclusions. These mechanisms are inefficient by design. They signal that the market is prioritizing survival over optimization. This is where suspense peaks. No single decision triggers the transition. No announcement declares a new regime. Instead, participants notice that things feel different. Quotes are less firm, delivery terms are more cautious, risk committees meet more often. Models are stress-tested with assumptions that once seemed extreme. The market begins to act as if a line has been crossed, even if it cannot yet name it. For policymakers, this creates a dilemma. Silver sits at the intersection of finance and industry. It is both a monetary metal and a strategic material. When pricing instability emerges, it raises concerns beyond speculation. Supply disruptions affect manufacturing, energy transition plans, and national security considerations. Authorities prefer calm markets, but calm cannot be forced when structure is strained. Attempts to stabilize prices through communication or liquidity measures often fail if they do not address availability. Markets can ignore words, they cannot ignore shortages. This is why historical transitions are rarely managed smoothly. By the time policy responses appear, capital has already moved. Contracts have already been rewritten. Trust has already been repriced. The most important consequence of this phase is a shift in reference points. When a benchmark no longer commands universal trust, participants look for alternatives. They may reference different markets, different settlement terms, or different instruments. The system fragments. Pricing becomes regional rather than global. Fragmentation is costly. It reduces efficiency, increases risk premiums, and complicates planning. Yet it persists because it reflects reality more accurately than a single-strained benchmark. This does not mean the old system disappears overnight. It continues alongside the new behaviors, gradually losing relevance. Those who rely on it exclusively find themselves surprised by outcomes they did not anticipate. History shows that this is how market authority changes hands, not through collapse, but through drift. The silver market is now at the point where drift matters more than drama. Each decision made by participants either reinforces the existing structure or accelerates its erosion. Most of these decisions are made quietly, guided by incentives rather than ideology. For business leaders and entrepreneurs, the lesson is clear. Markets send warnings long before they send signals. Those warnings appear in structure, not headlines. They appear in inventory behavior, settlement preferences, and risk management decisions. Ignoring them does not preserve stability. It delays adjustment until options narrow. This moment is not about predicting an exact price. It is about recognizing a change in how the market functions. When availability becomes uncertain, leverage loses appeal. When benchmarks strain, diversification gains value. When trust erodes, control becomes expensive. The silver market is approaching a point where these truths can no longer be ignored. Tonight's London Open is not important because it promises a dramatic outcome. It is important because it forces the system to reveal how much strain it can still absorb. Whether prices move sharply or not, behavior will speak. If pricing aligns with physical reality, confidence stabilizes, at least temporarily. If it does not, the gap between appearance and function widens. That gap is where opportunity and risk coexist. Those who understand this do not wait for confirmation. They watch how the system responds under pressure. They pay attention to what changes first, not what changes loudest. In markets, the most powerful signals are rarely the most visible. And when a market stops behaving like a market, it is no longer asking participants what they believe. It is testing what they are prepared to do.